inventory measures. They show profitability. An income statement tells you revenue, money coming in, expenses, the money going out. The net income is the profit or loss. Hopefully it's profit and not loss. If expenses are higher than revenue, the business is losing money. And if the revenue is higher than the expenses, then the business is profitable. Without this, you're basically just guessing. So it's really important to keep track of all the numbers. It helps with decision making. Business owners use income statements to cut unnecessary expenses, adjust pricing, see which products or services are profitable, plan budgets, decide when to invest or expand. For example, if your Shopify sales are high, but the profit is low, the income statement shows whether fees, ads, shipping, or subscriptions are eating into the margins. They're required for taxes. Income statements provide the numbers needed to file business taxes, show deductions, report profit to the IRS. Your net income from the income statement flows into your tax return. They can attract investors and lenders. Banks and investors look at income statements to decide, is this business profitable? Is revenue growing? Can they repay a loan? No lender will approve funding without reviewing financial statements. They show trends over time. When you compare income statements month to month or year to year, you can see seasonal patterns, revenue growth, rising expenses, declining profit margins. This helps with forecasting and long-term planning. They measure business performance. The income statement answers one core question: is this business financially healthy? It's like a report card for your company. So in short, an income statement tells you if your business is thriving or just vibing or slowly dying. Even if you hire an accountant, you still need to understand your income statement because it's your business, not theirs. Your accountant keeps the score, but you're the one playing the game, basically. If you don't understand where your money is coming from and where it's going and why a profit is shrinking, then you're basically driving a car while someone else reads the dashboard. Accountants organize the numbers, file the taxes, make sure things are correct, but you make the pricing decisions, choose expenses, decide when to hire, decide when to expand, etc. And if you don't understand the basics, you can't make smart decisions and you won't know if something looks off. So the truth is that you don't have to do all the math. You can hire an accountant, but you absolutely need to understand what the math is telling you. Okay. So, profit.
In this video, you'll learn what an income statement is. I'll show you what it looks like and how you can use it to measure a business's financial performance. Hey there, welcome back to Accounting Stuff. I'm James, and in today's video, we're going to cover the income statement, also known as the profit and loss statement, or the P&L for short. This is one of the three major financial statements in accounting, along with the balance sheet and the cash flow statement. Collectively, these reports give us an impression of a business's financial health, so it's important that we understand how they work. I've already made videos covering the balance sheet and the cash flow statement, which you can find linked up here and down below in the description. But up until now, I haven't posted a video yet on the income statement, and I've received a lot of requests from you guys to cover this topic, so thanks for all these. Particularly from one subscriber, so Niloy, if you're watching, this video goes out to you. Good luck in your exam, hope you crush it. An income statement is the summary of a business's revenues and expenses over a period of time. In its basic form, an income statement looks like this. It's a summary of a business's revenues and expenses over a period of time. When we take our total revenue and subtract our expenses from it, then we work out our profit or our loss. We make a profit when our revenues exceed our expenses, and on the flip side, we make a loss when our expenses are more than the income we've earned. This is why the income statement is also known as the profit and loss statement, or the P&L for short. It lays out a roadmap for how we ended up here at the bottom line, our profit or loss. The income statement always covers a period of time, which could be anything that we want it to be, but typically we run it for a month, a quarter, or a full year. Here's a helpful analogy that I read in this book, The Accounting Game, which I recommend reading if you're new to accounting. You can find my review of it up here. Anyway, back to it. If a balance sheet shows us a snapshot of a business's assets, liabilities, and equity at a single point in time, then you can think of it as a photograph or a still frame taken from a video, whereas the income statement covers a period of time. It's like watching a clip of that video. It has a beginning and it has an end. And if we look at it carefully and analyze it, then it can tell us a story. But more on that later. Let's take a closer look at our income statement. Revenues less expenses make us a profit or a loss. The problem with this layout is that it doesn't give us much detail. It would be much better if we made things a little more descriptive. For instance, revenue. There are many different types of revenue. If we were running a business that sells physical products, then we might want to call this product sales instead. Or if we provide services, we could call this our services rendered. This extra detail helps the readers of the income statement better understand what they're looking at. Clarity is the aim of the game here. The same goes for expenses. Businesses typically incur many different types of expense, but broadly speaking, these can be broken down into two categories: our direct costs of doing business and our indirect costs of running the business. Our direct costs of doing business are the costs which we can directly trace through to the products we've sold or the services that we've provided. For a business that provides services, we might call this our cost of services. And if we sell physical goods, then we could call this our cost of sales or our cost of goods sold. Direct costs like these are variable costs, which increase in direct proportion to the sales that we've made. If you were running a retail or a wholesale business, then these would include things like the original purchase price of the product that you're reselling. Or if you've run a manufacturing business, then this would include the cost of your raw materials or the direct labor cost that went into producing your product. As we make more sales, we incur more of these direct costs. Cost of goods sold can be a bit of a tricky concept to understand at first. It ties in very closely with inventory in the balance sheet. If you'd like to see me make a video explaining how all of that works, then let me know down below in the comments. And if you haven't already, remember to hit that subscribe button so you don't miss out on all of the other accounting tutorials that we have coming out very soon. Back to the income statement. When we take our revenue and deduct our direct costs of doing business, we get to our gross profit. If you're new to accounting, then you'll soon discover that we have many different types of profit. Our gross profit is a really useful tool that allows us to measure the efficiency of our production and sales process. I'll show you how that works in a minute. But first, let's jump back to indirect costs. These are the costs of running a business which can't directly be traced back to the production of goods or the provision of services. We sometimes call these overheads. Overheads can include fixed costs like rent, employee salaries, insurance costs, admin expenses, legal costs, accounting costs, marketing costs, depreciation, and amortization. Whoa, there's a lot of them. Fixed costs like these tend to remain the same. They bear no correlation at all to the sales that your business has made. However, not all overheads are fixed. Variable overheads can loosely correlate with a business's sales, although they can't be directly traced back to the production of goods or the provision of services. These include things like advertising costs, which can indirectly drive sales, and sales commissions. Utility costs could also be considered a variable overhead in a manufacturing business because these can increase as we ramp up production. When we deduct our indirect costs of doing business from our gross profit, we come to our operating profit. Operating profit measures the net income that we've generated from operations. This is the residual amount that's left over after deducting all of our direct and indirect costs of doing business. So this is our basic income statement. But how does it help us measure a business's financial health? It does that by giving us a means to compare our financial performance against comparative accounting periods. A comparative period is a different period of time. It can be whatever we want it to be. We could compare a current month income statement against last month's income statement, or this year versus last year. When we use comparative periods, we can calculate the change or movement across each line item down the profit and loss statement. And as accountants, it's our job to support these movements with a narrative which explains all of the differences. Let's throw in some numbers into an imaginary company, and I'll show you what I mean. We'll compare the movements in our P&L year on year. This is going to be for a medium-sized business, so we can quote our numbers in thousands of dollars. What have we got here? Our imaginary company has made sales of $110,000, which is up $10,000 from what we made in the prior year. Our cost of goods sold have also increased by $10,000, from $30,000 to $40,000. That's left us with a gross profit of $70,000, which has remained unchanged. Our overheads are fixed at $45,000, which gives us an operating profit of $25,000 in each period. What can we learn from all of this? Well, our sales have increased by $10,000, but our gross profit has remained exactly the same. How can that be? A useful metric that we can use to analyze this is gross profit margin. We can calculate our gross profit margin by taking our total product sales and deducting our cost of goods sold, and then dividing the whole lot by our product sales. This measures how efficiently we've been producing and selling our imaginary product. In this case, our gross profit margin in the current year is around 64%, which is actually down from last year's gross profit margin of 70%. How's that possible? Well, one of two things could be happening here. Our sales could be shrinking, or our costs could be rising. We could be selling more products, but at a discount, or the cost of our raw materials could be rising. These are the questions that we need to be asking ourselves as accountants, investors, or small business owners. We can compare metrics like the gross profit margin across comparative periods to help us identify what questions we should be asking. And then, that's when the work begins. We need to find out the answers and use them to build a narrative that explains what's going on. Gross profit margin is just one of many business metrics that we can use to analyze the income statement. If you'd like to see me make videos on the others, let me know. Now, this is still quite a basic income statement. In reality, there are other indirect costs of doing business which we might need to include as well. Things like interest expenses and tax. These tend to slot in below operating profit because they aren't considered to fall within the normal cost of operations. This is why operating profit is also known as EBIT, or earnings before interest and tax. When we deduct our interest and tax from our operating profit, we calculate our net profit, the bottom line, because it's at the bottom of the profit and loss statement. So you can see that there are many different types of profit and loss to consider in accounting. We start off with our revenue and we deduct our direct costs of doing business to come to our gross profit, our top line profit. Below this, we take out the indirect costs of running our business to find our operating profit, our EBIT, our earnings before interest and tax. And when we remove interest and tax, we calculate our net profit, the bottom line. Together, these different types of profit help us measure performance over a period of time. The main goal of most businesses is to maximize their profits, so it's important to be clear on what that means, and to be aware of the differences between gross profit, operating profit, and net profit, which can each tell us a different part of the story. Like I mentioned earlier, the income statement is just one of the three main financial statements, along with the balance sheet and the cash flow statement. I've made videos covering both of these already, which you can find here and here. If you found this one useful, give it a like, or better yet, share it with a friend, why not? Don't forget to subscribe for more accounting tutorials. I'll see you around.
So the objectives of this chapter, to define the elements of a skeletal profit and loss statement, also known as a P&L. To complete a skeletal profit and loss statement, understand the importance of controlling expenses in order to maximize profits, express gross margin, expenses, and profit as a percent of net sales. And recognize and calculate productivity or efficiency measures, including human resources, space, and inventory productivity. Operating profit is the result of the relationships among sales volume, cost of merchandise sold, expenses. The relationship of these three factors can be shown in a skeletal profit and loss statement. The skeletal statement shows 5 factors, 3 basic merchandising factors of net sales, cost of merchandise sold, and expenses, plus gross margin and profit. All of these terms might sound like a lot right now or be confusing, but it will make more sense once we start working through the problems. All right, so step 1, let's start with the the net sales. The net sales equals the total sales. So it's always 100%, since it's the total sales, and then minus returns, discounts, and allowances. So the net sales is 100%, and all percentages will be based on this number. Step 2, cost of merchandise sold is $60,000. So to find the percentage of $60,000, take 60,000 and divide it by 100,000 equals 0.60 or 60%. So that's how you find the percentage. Step 3, find the gross margin. The gross margin is 100,000 minus 60,000, which equals 40,000. Now let's find the percentage of $40,000. 40,000 divided by 100,000 equals 0.40 or 40%. So the gross margin equals $40,000. All right, step 4, subtract operating expenses. $36,500. Find the percentage. $36,500 divided by 100,000 equals 0.365, which equals 36.5%. So your operating expenses are 36,500 or 36.5%. But we add those zeros so they all line up. And then step 5, finding the operating profit. So the operating profit equals $40,000 minus $36,500, which gives you 3,500. And the percent is $3,500 divided by 100,000 equals 0.035, which equals 3.5%. So the operating profit is $3,500. So yeah, this slide is actually incorrect. This number 5,000 is wrong. It should actually be 3,500. The gross margin equals the net sales minus the cost of merchandise sold equals the profit plus expenses. Gross margin is the difference between net sales and cost of merchandise sold, sometimes referred to as gross profit. Yeah, it looks like there was a typo made on the profit one. Sorry about that. I didn't make this. This came straight from something in the book, but yeah, just so you know, that number is incorrect. All right, gross margin. Gross margin equals the profit plus the expenses. Gross margin is important because it shows the margin on merchandise alone. By looking at gross margin, buyers and managers can see whether sales and or cost of merchandise sold figures need an improvement. How can you increase your gross margin? By raising prices or decreasing the cost of the goods sold. Basically, trying to spend as little as possible on your merchandise and then marking it up. Profit or loss equals the gross margin minus expenses. Operating profit equals the net sales minus the cost of merchandise sold minus expenses. Profit occurs when gross margin exceeds expenses, and loss occurs when gross margin is less than expenses. Operating profit or loss. Net sales minus cost of merchandise sold equals gross margin minus the operating expenses equals your operating profit plus other income gives you your net profit. Other income examples would be tips, vending machines, etc. Extra.
Get them and help you understand why they are one of the most important things on your profit and loss. And if you don't see them, let me tell you why you want to see them. All right, on a typical profit and loss statement, you should see some numbers over here, which show the percentages. You have your dollar amounts and you have your percentages. And a lot of people go, what are those percentages? And if you don't see those percentages, you need to talk to your accountant because it's a simple button that they push when they print those profit and loss statements, and they can add these percentages. And if you do your own profit and loss in QuickBooks or in one of the other ones, there is a button or a option that allows you to put the percentages on there as well. You need to make sure that you have that on. And I'm going to tell you why, because I think you're going to find that this is a really powerful tool for you to increase your profits. Let's take a look at. Now, the main thing you got to do is let's focus on the basics first. Everything that you sell comes in to the business, correct? That's your sales. And then you're going to have money that goes out for your cost of goods. You're going to have money that goes out for your expenses. And if all plays out well, then at the end of the day, you have your business profits. Now, the thing to keep in mind is every single thing that comes into your business is up here at sales. So that's 100% because there's nothing above and beyond that yet. We haven't spent a dime. Sales come in. We have 100% of our money. And what we're going to do is we're going to show where that money goes and how that breaks down. Now, the key is to remember the number one calculation that if you've been following me, I preach all the time. This is the only thing you really need to super memorize, and that is sales minus cost of goods minus expenses equals your profits. This is important for you to know for your pricing, and we talk about that in our pricing videos, but more importantly, it's important for you when it comes to your profit and loss. And by the way, do you notice that it follows the sales funnel? All right, so this is important for you to keep in mind. Now, when we're looking at our profit and loss, let's see how it plays to that. We have sales, which is known as income on your profit and loss statement. We have cost of goods right here. Then we have our expenses, and finally we end up with our profits. Sales sales minus cost of goods minus expenses equals profits. And what you're noticing is your profit and loss statement follows that same calculation that I'm always telling you you need to know. Now, what we're going to focus on in this video is over here on the percentages. And where do those percentages come from? And how do you calculate them out? And more importantly, why are they important for you to know? Well, let's start breaking this down, shall we? Now, earlier I said that everything is a percent of sales, and your sales are 100% of what comes in. So you're going to notice that regardless of what you are selling, so you'll notice that there's services, products, you can break all of that down, but at the end of the day, your total sales is 100%. That's all the money that comes in to the business. That's always going to be 100%. And it's important that you keep that in mind. Now, first off, let's talk about why you need to understand these percentages, because every cost, every expense is a percent of your sales. It's a piece of that. It doesn't matter what it is. Your auto expenses are a percent of your sales. Your phone expense is a percent of the sales. The advertising that you do is a percent of sales. And yes, even your employees, your payroll is a percent of sales. Matter of fact, payroll is broken out a few different times on your profit and loss. And it's important that you understand every single thing is a percent of sales, including your bottom line profit number. Now let's take a closer look here, because if you know the percentages, it's going to give you insight into your business. And we're going to take a look at a couple of examples. Let's take a look at advertising. Let's just say you normally spend about $400 on advertising, and you've decided that, hey, there's this great opportunity, and I'm going to jump that up to $1,000. Well, if we know your percentages, you'll know that, okay, when I'm doing my normal budgeting, it's around 5% is how much money of my sales I spend on advertising. Well, if you want to get the return on the investment and the return on the $1,000 that you spend, but you want to try to keep it still at that 5%, you need to know what you need to do in sales in order for that $1,000 to pay for itself to stay in that 5%. Well, let's take a look. If you do the 5% with the 400, your sales are typically around $8,000. Well, if you spend the $1,000, the return that you're hoping to get to keep it at the 5% is now $20,000. If not, anything in between is going to be a higher percentage. Let's just say that you don't have an increase in sales at all. So you went out, you gambled, you tried something for an extra $600, and your sales are still at that same $8,000. Well, let's see what that does to your percent. You go from 5% to a whopping 12.5%. That's how you spent your money. So when you're looking at your sales, if they don't change and you spent more money in advertising and it jumps and you don't get that return, it jumps to 12.5% in this particular example. That's important for you to know, because now you can say, okay, that doesn't work, I need to pull back. Or you need to say, that's fine, I'm going to gamble for the next couple of months in hopes to hit that $20,000. Let's take a look at another example, and that would be payroll. Let's just say you have one person on your team and you pay them, I think it's like $13 an hour, 40 hours a week. They're going to make about $1,500, and your sales are about $6,000. So what percentage are you spending on this employee? Well, that's about 25%. Now let's just say you've gone out, the business has grown, and now you have a 5-person team, and now your payroll has jumped to $7,500. Your sales, they've also increased. They've increased to $25,000. And right now you're like, oh, this is not too bad. Well, let's see what percentage you're now spending on your payroll. Well, now you're spending 30% on your payroll. Now, that might not be a bad thing. What you have to ask yourself is, if I want to get this back down to 25%, one of two things need to happen. Either I need to get more out of these employees to increase those sales, or I may need to use less payroll, meaning I need to cut their hours, I need to let someone go, whatever the case may be. But if your goal is to stay at that 25%, something has to change. So you either need to get more productivity, get more sales, or you need to let someone go. This is why you see some of these businesses have to make hard decisions, because they have a payroll percent that they must meet every single month, which is why you see layoffs, people being let go, hours being reduced. It's because of this percentage, which is really critical, which is what these businesses try to stick to. And that's one of the things you want to, as you grow your business, you want to do the exact same thing. Now the question becomes, how do I calculate this out? Sounds great, Tammy. I'm getting excited. How do I do this? Well, the first thing you have to remember is everything is a percent of sales. And if you remember that, it's going to make it 10 times easier. So let's just say that your sales are $3,500 and you spend about $150 on your phone. What percentage is your phone of your sales? Well, you're going to take the $150, that's the expense, and divide it by your sales, because everything's divided by sales. So 150 divided by the 3,500 means it's 0.043, which is 4.3%. So in this case, if your cell phone is 150, and your sales are 350, you're spending 4.3% of every dollar you make on this phone. Now, for some of you, I know you're visual learners, so let me show you another way to better understand percentages and how this all goes. Let's pretend that 100% is really a dollar. There's 100 pennies, a dollar, 100%. We've all kind of learned this as kids when we were coming up. And everything going out of your business is the change you make from that dollar, because you have to break the dollar to be able to spend it on these other items that you're doing. And that's how we're going to look at it. So if we come back here to our profit and loss, we know our sales are 100%. And if we drop down here to our cost of goods, we see that 48% of that 100% is spent on costs, on wages, materials, stuff like that. And visually, what would that look like? Well, if our dollar represents the 100%, that means our cost of goods is 48%, which means 48 cents of every dollar is going out towards cost of goods. In this case, labor and materials for this particular example. Now, if we come back to our P&L, remember we keep going down the flow. Our top line here is gross profit. Now, I talk more about gross profit in our learning sessions on the profit and loss statement. You can check that one out here. I'll put a link to it also in the show notes. But that leaves us, if we're spending 48.1%, that leaves us 51.9. We're going to be rounding up for our examples here. Now, your gross profit is just letting you know how much more money you have left over for your expenses and your profits. In this case, our expenses are going to run 20.6 and our profit is going to run 31.3%. So let's go back to our visual, shall we? We know our sales are 100%. Our cost of goods we know is 48%. Our expenses are 20%, and our profit is 32%. So for those of you that like to look at the funnel version of it, this is what that would look like. And if you want to look at our visual with our money, we know our sales are 100%, so our dollar. We've got our cost of goods. We're spending 48 cents of every dollar on cost of goods. Our expenses are taking 20 cents of every dollar, and our profits are accounting for 32 cents of every dollar. So if you add up all those coins on there, it's going to equal that dollar. So hopefully that helps you understand a little bit better when you're trying to do percentages. The main thing you got to keep in mind is that everything is a percent of sales. That's one of the most important things you need to keep in mind, because when you're doing the calculation, it's everything is divided by those sales. Now let's take a look a little bit deeper on why you want to keep understanding this, because you can look at every line on your profit and loss and see what they run. Here are 3 examples. Advertising and promotion in this particular P&L is 2.1%, 2 cents of every dollar. Their insurance runs 3.1%, or 3 cents of every dollar. And their payroll expenses, which are different than your labor costs, right? Because those are under your cost of goods, but you have payroll that you have to run, and you have marketing, you have owner's wages, you have payroll taxes, you have all kinds of other stuff. In this case, for this particular owner, it's 4.7%, or basically almost a nickel of every dollar they take in is going towards this expense. So this allows you to be able to break this down, including maintenance and repair, telephones, uniforms. You name it, you can track it, and you can see how much money you're spending on each of those. Keep in mind, sales are always 100%. Every dollar you make is 100% for your sales, and all the change, what you make from that dollar, is going out for any of these different expenses in which you have. You can either track them in groups, cost of goods and expenses and profit, or you can break them down by line item. It's going to help you out. If you want to learn more about your profit and loss statement, like I said earlier, you can check out this playlist, or you can check out the link down below.
So step 1, operating profit or loss. We're going to take the net sales, which is 200,000, and the percentage is 100%. All percentages are based on this number. Step 2, you subtract the cost of the merchandise sold, and that is $126,000. To find the percentage, 126,000 divided by 200,000 equals 0.63, or 63%. Step 3, find the gross margin. 200,000 minus 126,000 equals 74,000. Gross margin equals $74,000. Now find the percentage. 74,000 divided by 200,000 equals 0.37, or 37%. So the gross margin is 74,000 or 37%. Subtract operating expenses. Operating expenses are $60,000. To find the percent, 60,000 divided by 200,000 equals 0.30 or 30%. So operating expenses equals $60,000 or 30%. Step 5, find operating profit. $74,000 minus $60,000 equals $14,000 for the operating profit. To find the percent, take 14,000 divided by 200,000 to get 0.07 or 7%. So the operating profit is $14,000 or 7%. Step 6, add other income. Other income equals $2,000. $2,000 divided by 200,000 equals 0.01 or 1%. Find the net profit. $14,000 plus $2,000 equals $16,000. Net profit equals $16,000. The percent, 16,000 divided by 200,000 equals 0.08 or 8%. The key rule to remember: subtract down the left side for dollar amounts and divide each line by net sales to get the percentages. Percentages must always add up correctly. If the net sales are $100,000 and the expenses total $40,000, find the expense percent. The solution: the expense percent equals the dollar amount of expenses divided by the net dollar amount of sales, equals $40,000 divided by 100,000, or 0.40, which equals 40%. Expenses totaled 40% of net sales. Profit and loss statement, operating statement, or income statements summarizes the income, cost of merchandise sold, and expenses for a specific period of time. It may be prepared for specific departments or an entire store, and several stores that make up a division within a corporation. It must show the percent corresponding to the dollar figure to allow for easy comparisons. For example, I could do a statement for my entire store, or I could make separate statements for clothing and then separate for accessories, etc. So here's an example of doing them separately for accessories and clothing, or you can do them all together. Profit and loss statement. So on the right side, you have the budget, and on the left, we put the net sales, cost of merchandise sold, gross margin, operating expenses, and profit. The net sale dollar amount equals the profit dollar amount divided by profit percent. Because cost of merchandise sold, gross margin, expenses, and profit are each expressed as a percent of the net sales, it is possible to calculate net sales when the dollar and percent figures are given for any one factor. If you know your profit and your profit percent, you can find out what your net sales were. Example 3.8. Last season, operating profit was $5,000, which represented 2% of net sales. Find the net sales. The solution: $5,000 is 2% of what number? So let's put dollar net sales equals 5,000 divided by 2%, and you get $250,000. Or 5,000 divided by 0.02 equals 250,000. Okay, let's walk through the first practice problem together. This is practice problem number 1 on page 49. Once you do this one, pretty much all 5 problems are done the same way. So first, step 1, start with the net sales, always 100%. Net sales is $14,000. The percentage is 100%. Everything is based on this number. Step 2, subtract cost of merchandise sold. Cost of merchandise sold equals $7,200. Find the percentage. 7,200 divided by 14,000 equals 0.5143 or 51.4%. Step 3, find the gross margin. 14,000 minus $7,200 equals $6,800. That's the gross margin. Now let's find the percent. 6,800 divided by 14,000 equals 0.4857 or 48.6%. So the gross margin equals $6,800 or 48.6%. Step 4, subtract expenses. Expenses are $5,900. Find the percent. 5,900 divided by 14,000 equals 0.4214 or 42.14%. So the expenses are $5,900 or 42.14%. Next, step 5, let's find the net profit. 6,800 minus $5,900 equals $900. The net profit is $900. Now let's find the percentage. 900 divided by 14,000 equals 0.0643 or 6.43%. Alright, so now go ahead and you can pause this and work through numbers 1 through 5 practice problems. I put an answer key on the next slide so you can check your answers. Okay, basic profit factors: net sales, cost of merchandise sold, and operating expenses. Gross sales are net sales plus customer returns. Net sales are gross sales minus customer returns. Operating income, sales volume, and sales productivity all refer to net sales. To arrive at net sales, customer returns are subtracted from gross sales. Gross sales are the total of prices charged to customers for all merchandise and services. Customer returns percent equals dollar return amount divided by dollar gross sales amount. Dollar gross sales equals the dollar net sales amount divided by gross sales percent complement. Customer returns percent is calculated by dividing the dollar sum of customer returns by the gross sales. Alright, now let's turn to page 52 and do practice problems 1 through 5. Okay, and you can pause this, and I'm putting the answers to the problems on the next slide. Just in number 6, I wanted to point this out. The complement method is another way of calculating the net price on items that are subject to trade discount. This can be dollar net sales divided by 1 minus the customer returns percent. 1 minus a percent is referred to as the complement of a percentage. See problem 6 of exercise 3.2 for an example of complement. Okay, so I have uploaded on the next slide the answer key for 1 through 6 in the practice problems. So hopefully this helps you understand. You can work through them. The cost of merchandise. The total cost of merchandise sold is influenced by several factors. Build cost of merchandise, transportation, cash discounts, alteration workroom costs. These factors must be controlled in order to maintain or improve profit. This will be covered in chapter 4 and 7. For example, shipping costs, repairs, etc. Operating expenses include the cost of wages for selling and non-selling employees, management salaries, utilities, advertising, supplies, fixtures, buyers' travel, and more. Direct expenses are the result of the operation of one specific department and would not occur if the department were eliminated. For example, consignment. Indirect expenses benefit the store as a whole and would continue even if a particular department were discontinued. For example, rent, parking, etc. Contribution or controllable margin is the amount left after direct expenses are subtracted from the gross margin, the money left after expenses. So going back to direct expenses, it says they are the result of the operation of one specific department and would not occur if the department were eliminated. So I can give you an example, the consignment example. So the way consignment works is when someone brings items into a shop on consignment, the items are there at the shop, and when the consigner gets paid once the consignment is sold. So they get a percentage every time their items sell. The shop pays them a percentage. So basically the way it works is the shop or business doesn't have to pay upfront for the merchandise, but they pay a percentage once it's sold. So I, just for example, I used to do consignment when I first opened my shop, and I split it 50-50. At the time, I thought it was a good idea because I didn't have a lot of merchandise, and I thought it would be a good way to get free merchandise, and also to bring in more people into the shop, because the consigners would tell their friends to come shopping and etc. But it ended up not being worth it for me because I was paying the consignor half, which was too much. I think it should be a smaller percentage, especially since I was the one doing all the work and all they had to do was bring in their item, and I was the one paying rent, doing all the sales and steaming everything, price tags, everything. So I cut that out because I was realizing that it was taking up way too much of my profit, and I was making more money by buying my own merchandise flat out at a cheaper price and then selling it, marking it up, rather than splitting it 50-50 with someone. And also it's just a lot to deal with, because when you do consignment, you have to deal with keeping track of everything that's sold and paying all those people, and it's a real headache. Also, you have to keep up with their merchandise. Sometimes people, they don't come pick up their stuff, and then you're kind of just stuck with it. So you gotta have some kind of an agreement in place where they have to come pick up their merchandise at a certain time, and it was just too much for me. But yeah, that's one way that I personally eliminated some of my business expenses was by cutting consignment, and it was probably one of the best decisions I ever made. Expense control. Analyze low gross margin areas. Control expenses while increasing productivity. Monitor and make adjustments as soon as factors appear to be slightly out of line. Retailers must carefully plan and control expenses. Refer to page 55. Companies must produce a profit to stay in business. Profit improvement plans would include increasing sales by analyzing merchandise, visual presentation, human resources, reduction of customer return %. Another profit improvement strategy is reduction in expenses. It is important for retailers to measure productivity or efficiency of sales, personnel, space, and inventory. Productivity is output produced compared with input expended. Human resource productivity, measured by selling costs, sales per transaction, sales per employee hour, sales per full-time equivalent. Space productivity, measured sales per square foot of selling space and sales per linear foot of shelf space. Full-time equivalent equals 35 to 40 hours per week. We'll come back to that later. Square footage is area / floor space, length times width. Linear footage is volume divided by shelf space. Length. Take advantage of your space to increase sales. The productivity of human resources can be measured in a number of ways. Selling cost, sales per transaction, sales per employee hour, and sales per full-time employee equivalent.
Businesses need to have a strategic plan for human resource management to reduce costs and improve productivity. There are several ways in which a company can save money by implementing a strategic plan for human resource management. The most successful firms develop and implement an effective strategic plan to help them achieve their corporate objectives. However, even the most acceptable strategic plan would be useless if the human resources department is not in line with it. Let's explore a game plan businesses use to improve productivity and save money. 1. Implement an employee retention strategy. According to the Bureau of Statistics, the employee turnover cost in the US is averaging $1 trillion annually. How? In simple logic, a business spends funds and time on sourcing and training new talents who will eventually leave them after a short engagement. Repeating the process of recruitment, onboarding, and training to cover the attrition rate is more expensive than employee retention. Having high employee retention allows you to allocate your funding to other profitable business operations and build a strong company culture. New hires create lower productivity compared to long-term team members because new hires' familiarity with the products and service operations is not yet well established. By keeping your team happy and engaged, you can avoid the costs associated with a high turnover rate. 2. Invest in employee development. Providing your employees with consistent training programs can help them reach their full potential. Also, strengthening your team's product knowledge helps them provide a better customer experience. Incorporating your training modules with gamification like achievements unlock and certifications will make learning an enjoyable experience for them. 3. Implement flexible work arrangements. Giving your team members the ability to work on their own time increases employee retention. There are effective strategies you can adopt to ensure that you will remain on top of your output delivery despite this flexible arrangement. A good example is focusing on the output quality and the deadline, which means they can work whenever they want for so long that they will deliver a competitive output on time. You can place milestone checks in between to guarantee that your team remains aligned with the goal. You can also set up recurring meetings that overlap with everyone's availability daily to check for their progress and struggles that you may need to address as early as possible. For operations that require a shift schedule like providing customer support, allowing your team the ability to coordinate with one another regarding their shift schedules is the best approach instead of micromanaging their time. They can agree on who will cover what shift schedule. This process encourages them to commit and become accountable team members. 4. Encourage a healthy work-life balance. Ensuring that your employees have the time they need to take care of themselves, you can help them avoid burnout and stay healthy and productive. Allowing your team members the ability to trade shift schedules whenever they need is one best example of giving them the ability to distress. They can get to enjoy their time off without sacrificing any of your service level agreements. Meeting your business requirements while letting a team member take a break from the pressure and rejuvenates himself is a win-win approach. 5. Create a performance incentive programs and promotions. Making your team feel they are indeed acknowledged for a job well done encourages them to give their best in everything they do. An acknowledgement comes through words, but if you want to make it even more powerful and leave an impact on them, providing a monetary reward and promotions work like magic. Investing in people who give out their best effort to become a contributor to your business growth is the best way to amplify your revenue than spending more to recover from an employee attrition rate. After hearing these, you may be able to assess the importance of developing a comprehensive strategic HR plan for your company's success. You can reduce costs and improve productivity by taking the time to implement the given strategies or create your own. Your company's success depends on it. Have you found this helpful? We still have more strategies to share for your business. Make sure to subscribe to our channel, tap the bell icon, and select all to get notified whenever we post a new video.
Okay, yeah, this is really good. It's, as a business owner, not one person can do everything on their own, and sometimes it pays off to have employees or team members to help you out so you can make more money, and that's the whole point, is to increase the profitability of your business. For example, what I have been doing, I have an online store, and in addition to the storefront, and it's really important for me to have my online sales up and running, like steady, because sometimes there's not a lot of foot traffic on certain days or certain times of the year, and it's really slow in the store, but the online sales help keep the business open, and it's really important to have help, because with what I do is I do all the buying and sourcing, and I find all the things that I want to sell in my shop, but it takes time to do that. I have to go spend like whole days on buying trips, and then while I'm doing that, I need someone to be at my store and helping customers, but I also have them taking photos and measurements for my Etsy shop, and I also have an eBay and a Shopify store. But it's very helpful to have people doing photos and measurements for me while I can be shopping, and then I can also be listing the items on Etsy. So while they're doing photographs and pictures every day, I can be listing them, and it just helps increase profitability and productivity. And but I've learned a lot with that. I have an app that I use called Connect Teams to communicate with them. So basically, I think it's better to communicate through some kind of an app or something separate than just from texting. It's nice because everyone can also communicate with each other through this app, and they can clock in and clock out, and it just makes it, I think it helps people work a little more independently, so I'm not constantly watching them the whole time. They can, I give them deadlines. I tell them I need all the photos and measurements 30 minutes before your shift ends. So basically they can do the photos and measurements however they like, as long as they reach the standards. I give them standards of, this is how the photos need to look. I need to have a good shot on the mannequin or on a model, a really good picture. And then I also need to have close-ups of any damages of the item, as well as the front and the back, and it can be laid flat. But they have the guidelines and they have the deadline, so that pretty much lays it out for them. I think it's important to have deadlines, because if you don't, sometimes they don't know what to do, and you know, it's just easier for everyone if we all know what to expect from each other. So anyways, you get the picture. But yeah, this is a great video. All right, moving on. Selling costs. Gross wages equals numbers of hours worked times hourly pay rate. Selling cost percent equals gross wages divided by net sales. Selling cost percent is the relationship between sales productivity, net sales, and wages. Can be calculated for individual salesperson, a department, and the store or other retail format as a whole.
This video is about how to calculate gross pay for hourly and salaried employees. Gross pay is the amount of money an employee earns in a specific time period before any deductions. If an employee is paid weekly, she will be interested in her weekly gross pay. If she's paid monthly, she will want to know her monthly gross pay. But remember, the gross pay is always before deductions, so what the employee actually takes home will be different. There are lots of different ways to calculate gross pay depending on how an employee is paid. I'm going to describe the two most common ways, hourly and salary. When an employee is paid hourly, he is paid a fixed amount for every hour of work. So if he gets paid $10 an hour and he works 8 hours, his gross pay is $80. An hourly employee's gross pay must be calculated on a weekly basis, whether he is actually paid weekly or not. This is because of a little thing called overtime. The federal government's Fair Labor Standards Act says the rules for overtime are: employees must receive overtime pay for hours worked over 40 in a work week at a rate not less than time and 1/2 their regular rates of pay. What this means is if an employee works more than 40 hours during a 7-day stretch, he must be paid overtime. So this complicates our gross pay calculation a bit, because we need to check the total number of hours that each employee worked to see if they worked more than 40. Here's an example. Luke works 5 hours on Sunday, 8 hours on Monday, 10 hours on Tuesday, 9 hours on Wednesday, 8 hours on Thursday, 7 hours on Friday, and 4 hours on Saturday. If he is paid $12 an hour, what is his gross pay for this week? The first thing we need to do is add up all of Luke's hours. Now we'll split it into regular hours and overtime hours. The first 40 hours are regular hours, and the remaining 11 are overtime hours. So we'll calculate Luke's gross pay by first multiplying his regular hours by his regular rate of pay of $12. That gives us $480. Then we'll take his overtime hours and multiply them by his regular rate of pay, $12, and then increase it by 1.5 times by multiplying by 1.5. So 11 times 12 times 1.5 is 198. Finally, we need to add the regular pay to the overtime pay. 480 plus 198 is $678. So Luke's gross pay for the week is $678. Now what about if an employee is paid a salary? Salary is usually quoted annually, but it's not uncommon to see monthly salary quoted as well. To calculate the gross pay for a specific pay period when given an annual salary, take the annual salary and divide by the number of pay periods in a year. The most common payroll periods are weekly, bi-weekly, semi-monthly, and monthly. Remembering how many payroll periods there are in a year for each can be tricky. Start by remembering that each year has 52 weeks. So if an employee gets paid weekly, divide the annual salary by 52. If an employee gets paid bi-weekly or every 2 weeks, the number of payroll periods is 26, or 52 divided by 2. So the gross pay is the annual salary divided by 26. For monthly and semi-monthly payroll periods, remember that each year has 12 months. So if an employee gets paid monthly, divide the annual salary by 12. If an employee gets paid semi-monthly or twice a month, the number of payroll periods is 24, or 12 times 2. So the gross pay is the annual salary divided by 24. It's that easy. So let's do an example. Ivy makes $35,000 per year. Let's calculate her gross pay for the 4 different payroll periods. If Ivy is paid weekly, her gross pay every week will be $673.08. If Ivy is paid bi-weekly, her gross pay every 2 weeks will be $1,346.15. If Ivy is paid semi-monthly, her gross pay twice a month will be $1,458.33. And if Ivy is paid monthly, her gross pay every month will be $2,916.67. Don't forget that although Ivy's gross pay is different depending on how frequently she gets paid, she is still paid $35,000 over the entire year, unless of course she gets a raise.
Okay, calculate the selling cost percent for a person who worked 38 hours at a wage of $8.10 an hour and had net sales of $2,849. The solution: the gross wages equals 38 hours times $8.10 an hour equals $307.80. The selling cost percent equals $307.80 divided by the net sales, which were $2,849, which equals 10.80%. Calculate the commission a salesperson would earn on a net sale of $1,200 if the commission were 10% of the net sales. The solution: the commission dollar amount equals the net sales times commission percent. $1,200 times 10% equals $120.
In this tutorial, I'll show you how to calculate commission and gross pay. Many salespeople earn a commission, which is a percentage based on the sales. There's 2 types. Straight commission, which means that your entire pay is based on the amount that you sell, and there's also salary plus commission, where you earn a set amount of pay plus an additional amount based on sales. So in this kind, there's a guarantee pay even if you don't sell anything. Question 1 reads, Marissa is a restaurant supplies salesperson and receives 6% of her total sales as commission. Her sales total $12,000 during a given week. Find her gross earnings. In this situation, Marissa is earning straight commission. So we'll take $12,000, the amount that she sold, and we'll multiply it by the percentage, which will convert as a decimal by dividing by 100%. So if I divide this number by 100, I'll end up with 0.06. Using our calculator, 12,000 times 0.06 gives us 720. This means that she earned $720 that week that she sold $12,000 worth of material. Question number 2, Melanie works for a cosmetic company and earns $200 a week in salary plus 30% commission on all sales over $500. She had sales of $1,250 last week. How much were her total earnings? So only if she sells more than 500 does she start to earn commission, and it's a big percentage, 30%. The first thing that we have to do is find out how much after 500 did she earn. Obviously she earned more than 500, but how much more? We'll subtract with 500. Combining these, we end up with $750. So $750 worth of sales will be based on this 30% commission. We'll do the same thing as in question number 1. We'll multiply this now by 30% or 0.3 after dividing by 100. Let's use our calculator. 750 times 0.3 gives us 225. This means that for this particular week, she earned 200, which was her salary amount. She gets that regardless of how much she sells, and the commission of 225. 225 plus 200 gives us 425. Finally, in question number 3, find the gross earnings if Juanita earns 275 plus 4% of all sales over 3,000 and the sales for a week are 18,756. That's really hard to do, to sell $18,756 worth of product, generally speaking. Anyway, I'll take this number, subtract it with 3,000. I don't need my calculator for that, actually. I should end up with 15,756. So this is the amount at which you can get commission for, and it's 4%. So that's the decimal equivalent. 15756 times 0.04. And that is the commission amount plus her salary of $275. So I'll add $275 onto this. Juanita earns $905.24. 905.24. That is her gross earnings. And remember the difference between gross and net. This is what she earned before all the deductions, such as taxes or whatever she's paying into. So obviously her net pay will be less than this when she receives her paycheck. Anyway, that is how to calculate commission and gross pay. If you have any questions, please leave a comment below or visit our website at biology-forums.com.
Okay, yeah, so commission, I think, is a good way, an incentive for salespeople to increase their sales. I used to work in a shop where I was an assistant manager. It was a clothing boutique, and we also had furniture. And I forget what the percentage was, but it was, I got paid a set rate per hour, and then also a commission on top of that. And they also had something where if you sold over $1,000 worth of merchandise in a day, that you would get a gift card. It was a $100 gift card. So every time if you sell $1,000 in a day, you get the $100 gift card, and that was great incentive for me. I really pushed myself, and I always got the gift card at least every week. And the cool thing was too that since they had furniture, the furniture is more expensive, so you could sell, you know, than clothes, because the clothes are less expensive than the furniture. You have to sell more clothes to make the $1,000. But if you sell like a couch, and then you also sell like $500 worth of clothes, you get the $1,000. And yeah, it was a great incentive. I think it's a good way as a business owner to get your employees motivated to make more sales by giving commission. Average commission earnings per hour equals the total commission divided by total number of hours worked. Salespeople may calculate their average commission earnings per hour by dividing their total commission by the number of hours they worked. calculate the average earnings per hour for a salesperson who works 25 hours and earned a total commission of $275. The solution: the average commission earnings per hour equals the total commission divided by the total number of hours worked. So $275 divided by 25 equals $11 per hour. Gross earnings: the number of hours worked times the hourly rate plus commission. Average earnings per hour equals the gross earnings divided by the total numbers of hours worked. Some retailers use a combination of hourly wages and commission for all or some of their employees. The combination guarantees the employee a minimum level of wages. A salesperson earns $10 per hour plus 6% commission on sales. Last week, she worked 38 hours and had net sales of $4,821. Calculate a selling cost percent and average earnings per hour. The solution: gross earnings equals 38 hours times $10 per hour plus net sales of $4,821 times 6% commission. So we get $380 plus $289.26, which equals $669.26. The selling cost percent equals 669.26 divided by the net sales, which was $4,821, which equals 13.88%. Her average earnings per hour were $669.26 divided by 38 hours, which equals $17.61. Average earnings per hour. The average unit per transaction equals gross units divided by number of transactions. Units per transaction measure the average number of items that customers are purchasing in a transaction. The higher the UPT, the more items customers are purchasing during each visit. To determine the average units per transaction, divide the gross units purchased by the number of transactions for the period. Some ways that this could happen is by upselling, like adding on items. For example, in my shop, somebody might come in looking for, they're going to a 70s party and they're looking for some outfit to wear to the party, but you can upsell by adding on accessories, scarves, bags, all kinds of things, sunglasses. Also cross-selling and adding accessories, candy. Sometimes that's the way a lot of stores upsell and add items, is at the checkout you have little items like pins, jewelry, earrings, sunglasses, candy, even candy, because it's like, who doesn't love candy? Okay, I'm not really sure what's happening with this video, so alright, I guess let's see, I think maybe it's not working. Here we go.
Sales KPIs or key performance indicators are metrics that are calculated to indicate the real reason behind sales performance. The main three sales KPIs in retail and e-commerce are ATV or average transaction value, UPT or units per transaction, and conversion. ATV is calculated by dividing total sales by total number of transactions. For example, if sales for the day are $10,000 and the number of transactions are 120, then ATV equals $83. This simply means that on average, every customer who bought has spent $83. When you look at the sales report for a certain period and find that sales are below target, you can then calculate ATV to see if it's meeting the average or target or not. If ATV is below target, then the store team will need to work on increasing ATV, which in return will improve sales. ATV can be increased at the store using sales techniques such as upselling, cross-selling, and suggesting add-ons. UPT can be calculated by dividing the total number of pieces sold by the number of transactions. UPT can be increased at the store using sales techniques such as cross-selling and suggesting add-ons. It can also be increased by expanding the product assortment to include relevant products that appeal to the same customer. Conversion is calculated by dividing the total number of transactions by the total number of customers who entered the store and multiplying the result by 100 to get the percentage. Conversion can be improved in a number of ways, such as improving the sales team's product knowledge, changing the store layout and display to help customers find what they want easily, improving the checkout experience to avoid turning customers away by long queues, suggesting the right alternatives to customers who come and don't find the product they were looking for. Increasing ATV, UPT, or conversion will all lead to increasing sales. However, it is a good practice to choose one of those KPIs as a focus for the week or month and brief the team on ways to improve it and track improvement over that period. Then you can move on to working on the next KPI that needs improvement, and so on.
A salesperson sold 120 units and had 40 transactions. Determine the average units per transaction. The solution: average unit per transaction equals gross units divided by number of transactions. 120 divided by 40 equals 3. If you have 2 salespeople and one person has 5 units per transaction and the other only has 1 unit per transaction, does that mean they are working harder? Average sale per transaction equals gross sales divided by number of transactions. This measures salespeople's productivity and indicates ability to capture the customer's interest. Sales per employee hour. Net sales divided by number of employee work hours. Relate sales for a period to the number of hours employee worked. Often used in retailing as a performance review component. If gross sales totaled $25,400 on 112 transactions, determine the average sale per transaction. The solution: average sale per transaction equals gross sales divided by number of transactions. 25,400 divided by 112 transactions equals $226.79. Sales per employee hour equals net sales divided by number of employee work hours. Relate sales for a period of the number of hours employees worked, often used in retailing as a performance review component. During the past week, sales at one store totaled $359,000. During the same week, employees worked 3,890 hours. What were the sales per employee hour for the week? The solution: sales per employee hour equals net sales divided by the number of employee work hours. $359,000 of sales divided by 3,890 hours equals $92.29. Sales per full-time equivalent equals net sales divided by number of full-time equivalent employees. This measures sales productivity based on full-time employees. Full-time employee is a worker who is employed year-round and who works generally 35 to 40 hours per week. Is the relationship between sales per full-time employee equivalent is the relationship between sales for a period of time and the number of full-time equivalent employees who work during that period. Part-time employees must be converted to full-time equivalents by totaling the number of hours worked by part-time employees and dividing by the number of hours considered to be full-time, be a full-time week. In most businesses, 35 hours to 40 is considered full-time. Alright, a department had weekly sales of $35,600. 2 full-time employees worked 35 hours each, and 8 part-time workers worked a total of 210 hours. If the store considers 35 hours to be full-time, determine the sales per full-time equivalent. The solution: number of full-time equivalent equals 210 divided by 35 plus 2, which equals 8. Sales per full-time equivalent: the net sales divided by the number of full-time equivalents. $35,600 of sales divided by 8, there's 8 people, part-timers, equals $4,450. A department had weekly sales of $35,600. 2 full-time employees worked 35 hours each, and 8 part-timers worked a total of 210 hours. If the store considers 35 hours to be full-time, determine the sales per full-time equivalent. The solution: the number of full-time equivalent equals 210 hours divided by 35 hours worked each, plus 2 equals 8. Sales per full-time equivalent: the net sales divided by number of full-time equivalents, $35,600 divided by 8. There were 8 part-time workers. Sorry, there's an ice cream truck driving by. The answer is $4,450. Alright, now let's turn to page 60 and do practice problems 1 through 5, exercise 3.3. And I'm gonna put the answers again in the slides so you can check your work. And it should break it down for you, so it shows you exactly step by step how to do these. I'm gonna add it to the slides. If you're looking for the slides, it's located in each week in the modules. All right, let's just do a couple examples of these problems. Let's do number 3 together. So number 3, a salesperson working 40 hours per week received a wage of $7.75 per hour. If she sold $1,986 of merchandise, what was her selling cost percent? So 40 hours were the earning, 40 hours times $7.75 per hour. Gross sales are the same as net sales since there are no returns. So 310 divided by 1,986 $286 worth of merchandise equals 15.61%. Alright, and then problem 4 is pretty much the same as number 3. And then let's go do number 5 together. So number 5 says, a store pays all of its employees $7.50 per hour. For the week, the store has scheduled 164 hours of sales help. If the store desires to maintain the same selling cost percent when the minimum wage goes to $8, how many hours of sales assistance can be allowed so that the store still maintains the same selling cost? $7.50 times 164 hours equals $1,230. To get this, you divide $1,230 by $8, so the earnings are the same, $153.75. Space productivity. The most common measure of space productivity is sales per square foot of selling space. Sales per square foot is used to monitor the productivity of a department or a store. Space productivity may be used in planning sales and determining the space needed for a merchandise category. Determining how much of what product to sell, which items are selling, and how much space in the store should be dedicated to those items. For example, sunglasses, jewelry, clothes, etc. Sales per square foot of gross space equals net sales divided by square feet of space in store. Sales per square foot of selling space equals net sales divided by square feet of selling space. Sales per square foot are determined by dividing the net sales by the appropriate number of square feet of a space. Last year, a store had sales of $23,994,000. If it has 86,000 square feet of selling space, what were the store's sales per square foot last year? The solution, sales per square foot equals net sales divided by square feet of selling space. 23,994,000 divided by 86,000 square feet equals $279. Sales per square foot as a planning measure. The amount of space equals sales volume divided by sales per square foot. It can be used to estimate the amount of space needed to support a planned sales volume by using available sales per square foot data. If the sales per square foot in the handbag department in a single unit of a chain store averages $280 annually, and the annual sales for a new department are planned at $252,000, what amount of space should be allocated to the new department? The solution, the amount of space equals sales volume divided by sales per square feet equals $252,000 divided by 280 equals 900 square feet. Estimated sales equals square footage of space times sales per square foot. It can be used to estimate sales for a store or department by multiplying the amount of space by the expected sales per square foot.
In this video, we're going to discuss sales per square foot, or depending on where you live, sales per square meter. So sales per square foot is a very common metric that's used in the retail industry, and we calculate it as follows. We take the total amount of in-store sales, and by in-store I mean we are going to exclude any online sales the company makes. We take the in-store sales and we divide it by the size of the selling area. And the size will be measured in square feet or square meters. And what we're trying to do with calculating this is to measure the efficiency of this retail company. How good is this retailer at taking the space it has and squeezing and wringing out sales out of this? How good are they at making use of their space? So let's do an example to calculate this, and I'll talk about some actual retailers. So let's say we've got a company called Rachel's Candy Shop, and they generated $300,000 of in-store sales. And again, that ignores any online sales that the company might have made. And the selling area for Rachel's Candy Shop is 2,000 square feet. So the selling area would ignore, like, let's say she had a stock room where she kept the extra candy and her inventory. We ignore that because that's not part of the selling area. We want to see how good are you at using the area you have available to sell things, okay? So the selling area is 2,000 square feet, 300,000 of in-store sales. So we take 300,000 divided by 2,000 and we get $150. So the sales per square foot would be $150 for Rachel's Candy Shop. So let's look at some actual companies. I went online and pulled out the data for a few firms. I've got Walmart, Costco, and Target, and I found their sales per square foot on an annual basis for 2013 through 2017. And what's interesting here is actually you'll notice that Walmart has steadily been declining. Okay, sales per square foot has been going down. And Costco has actually increased. There was 1 year here where they didn't increase, but generally they have been going up. And then Target, they were going up a little bit, and then they went down here in 2016 and then came back up. So we see some general trends. It's not looking good for Walmart in terms of sales per square feet. But Costco is actually looking pretty positive, right? Pretty positive. So now I put this into a graph to help you see, and you'll notice now not only, so we looked at the downward trend for Walmart, and then we had the upward trend for Costco, and then pretty stable for Target. But you'll notice when we see the graph, look at how much different it is. So the red bar here, that's Costco. Look at how much different it is compared to both Walmart and Target. Costco is far and away having much higher metric in terms of sales per square foot than its competitors are. And this just tells you how good the company is at making use of its space. And if you think about it, when you walk into a Costco, they often have things stacked very, very high. So they are clearly making very good use of the space they have. They're even using vertical space by stocking things so high, and they're just doing a really good job of wringing out sales, of given the space that they have, of just getting much more revenue than Target or Walmart has been able to do.
Yeah, so use of space is very important. Since if you're a business owner, you're paying for that space, you want to maximize every part of the space so you can get the most out of it. If 900 square feet of space in a new store has been allocated to the handbag department and the average sales per square foot for this department and other units of the store is $280, what annual sales volume would be expected? The solution: estimated sales equals the amount of square footage times sales per square foot. 900 times $280 equals $252,000. Sales per linear foot equals dollar amount of sales divided by linear feet of shelving. Relates sales to the number of linear feet of shelf space used by department, merchandise category, or brand. Indicates which brands vendors should be allotted additional shelf space. A store devotes 30 linear feet of shelving to hairspray. If sales per week for hairspray total $1,242, what are the sales per linear foot of shelving? The solution: sales per linear foot equals dollar amount of sales divided by linear feet of shelving. $1,246 divided by 30 feet equals $41.53. All right, turn to page 65 and do exercise 3.4. We're gonna do 1 through 5. And again, in the slides, I'm gonna put the answers on the next page so you can check your answers. All right, so number 1, annual sales divided by selling space. The annual sales equals $672 million. The selling space, square feet, is 500,000. Sales per square foot is $1,344. And the way you solve that was by taking the annual sales divided by the selling space. All right, number 2, the selling space times the sales per square foot. Annual sales are 23,994,000, and the selling space square feet is 86,000. So the sales per square feet is 279. And the way that we solved that was by taking the selling space times the sales per square foot. So it asked, a moderate priced 86,000 square foot department store had annual sales per square foot of $279. Determine the store's total sales. All right, next, number 3. A branch department store has a total of 220,000 square feet of space. 12% of the total space is considered non-selling space. If net sales were 59 million last year, determine the store's sales per square foot of selling space. All right, so number 3, the annual sales, the non-selling space equals 12% times the total space. The sales per square foot of selling space equals annual sales divided by selling space. The annual sales equal 59 million, and the total space equals 220,000. So, no selling space equals 26,400. Selling space equals 193,600. Sales per square foot of selling space equals $304.75. Common methods of inventory productivity: stock turnover, gross margin return on inventory, GM ROI, calculated by dividing the dollar gross margin by the average inventory at cost, is stated as a ratio. Gross margin return on inventory best serves as tool for measuring the productivity of individual product categories. GM ROI equals gross margin dollar amount divided by average inventory at cost. Calculate GM ROI from the following data. Net sales are $550,110. Excuse me. The gross margin 38%. Average inventory at cost is $66,180. The solution: calculate the gross margin. The gross margin dollar amount equals the net sales times the gross margin percent, which equals $550,110 of net sales times 38% gross margin equals $209,041.80. Calculate GM ROI. GM ROI equals the gross margin dollar amount divided by the average inventory at cost. So now we have $209,041.80 divided by $66,180, and we get 3.16.